So I talk all the time about whole life insurance being an amazing asset, a foundational asset that people can use in their life. And there's a lot of people online that are talking about infinite banking, whole life insurance, index universal life, and how to utilize life insurance as an investment or an asset. Everybody talks about it in all these different ways. And what I thought I would do in this video is break down the different types of cash value life insurance that there are, because not all whole life insurance is created equally, not all cash value life insurance is created equally. And so as you are trying to figure out what to sell or what to buy for yourself and figure out what type of whole life insurance or what type of cash value life insurance policy would make the most sense for you and your specific situation and goals and needs, which one is best for you? How do you make that decision? And so what I'm gonna do in this video is I'm gonna go through all the different options, and I'm gonna try to break it down and keep it as simple as possible. So if you find value in this, please like it, share it, get it out there to the people. If you haven't already, subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we are talking about the different types of cash value life insurance that you are probably trying to sift through to figure out, get through all the noise, what type of life insurance policy is best for you, or which one should you offer to your clients that you're trying to serve, and ultimately understanding the different parameters that you kind of have to sift through to make that best decision. So what I'm gonna do is I'm gonna get right to the punch here, and let's go through this. So let's see here, different types of cash value life insurance, as you can see here. So here's the deal. We have full pay, whole life. So full pay whole life is basically a full whole life contract that endows at 120 years old. So if you live to 120 years old, then that will endow. Obviously, I don't think anybody's banking on getting to 120, but at the end of the day, here's the deal. It's important to understand that when you buy a full pay whole life insurance policy, what they do is they're basically taking the fees and the cost of insurance and they're spreading it out over that time frame. And so what you're gonna find is a lot of times, a lot of people will like to run these policies that are 120 years old, because what happens is the annual cost of insurance, I can't spell apparently, the annual, I'm gonna do that again, the annual COI is less, because it's spread out over a longer period of time, that 120 years. If you buy it at 40 years old, that means you have 80 years of the insurance for, like if you bought $1 million of death benefit, that $1 million of death benefit gets spread out, aggregated over that 80-year period of time. So that's important to understand. And that principle exists in every single policy. So this is a full pay policy. This is kind of like your classic whole life insurance that a lot of people pay. Now, the downside to having a policy of this nature, the negative to it is that you always are responsible for a premium. And the challenge is, if you retire, let's say you retire at 65, that means what do you have? You have 55 years of no income where you have to make a premium, right? So that can be challenging for people. And so what companies have done is they've started coming up with different types of policies. So you're gonna go and you're gonna see different companies will offer like another policy, and we're gonna work our way backwards, like an L95 policy. What does that mean? It means life 95. And that means you are responsible for premiums until the age of 95 years old, right? And so that is what it is. So it's going back to the example, when we talk about, a 40-year-old, that 40-year-old, that cost of insurance, if you buy that $1 million of insurance, the cost of the expense of the insurance is spread over a smaller window. They have to compress, instead of paying to 120 and amortizing the cost over that, they spread it until the age of 95, and therefore the cost of insurance is a little higher on an annual basis because it's just spread out and it's always level in whole life insurance. And when you do that, obviously it can have the cash value doesn't accumulate as effectively right early in the policy. And so then other companies have been doing policies, they don't call them this, but there are policies that are like pay to 75, pay to 65. They all have different names. like some companies call them something like, they give them an actual name, or maybe they'll call them like a select product that creates some flexibilities. You can create different options. But at the end of the day, it depends on the company, depends on what it is. But at the end of the day, that is what it is. There are different time frames that I know a lot of people really like, these pay to 65 and pay to 75 options, because at the end of the day, let's face it, if you are looking to retire at, say, 65 years old, to know that your policy can be completely paid up at 65 is a really big relief for a lot of people, to understand that there's not going to be any stress on the policy to have to maintain it, or there's not going to be any stress on your cash flow to have to maintain the policy premiums once you're in retirement. That could be a really beautiful thing. Whereas if you do the L95 policy, it's kind of like you're going to get to 65 and now you can illustrate it so you don't have any money coming out of your policy. But if that's the case, if you're going to have 30 years where you will have to still pay that premium. Now you can either do an RPU at that age, but if you typically do an RPU at 65, which is a reduced paid up, where you reduce the death benefit, you pay up the insurance, you're gonna lose the living benefits typically in most situations when you do an RPU. The other thing you can do is a premium offset through surrenders and policy loans with the policy. But once again, if you're planning on utilizing this policy as a volatility buffer, or for any kind of income in retirement, or for any kind of leveraging it for any kind of like loan purposes for investments with real estate or anything of that nature, you want to be able to tap into the living benefits. Well, there can be risks in using the premium offset feature, and so it's definitely an option for you, but understand that there's no free lunch. That always comes with risk when you do that. That's why I like these 75 and 65 pay, because it really kind of takes the control and puts it back into you. Now, does it take it and make the insurance a little more expensive? Yes, it does. But if you design the policies properly, it still really can be efficient, even when you do that. Will it be as efficient as an L95? No. But I always tell people, you can't solve long-term problems with short-term thinking. And so the cost on the short term of giving up literally just like a couple percentage points of liquidity for the perspective of having more control over that 30-year period of retirement, to me, is infinitely worth it, and something that everybody should consider. Now, on the other side of it, let's go to the limited pay policies, right? Because I think it's really important to understand this. So what we have here, and by the way, these are kind of versions of limited pay. Even the L95 is kind of a version of a limited pay. Those are kind of quote unquote limited pay versions. But when I say real pure limited pay policies, I'm talking about, no matter what age you are, I'm talking about a 10 pay, a 15 pay, and a 20 pay. Those are the most common ones that we see. So what does this mean? This means that no matter what your age is, you're gonna pay for 10 years. This means that no matter what's going on here, you're gonna pay for 15 years or 20 years if you buy these policies, right? And so when you look at it through that lens, it's actually can be really powerful, and you would look at this and you would say, wow, this is really good. So what they do is they take, once again, if you buy a life insurance policy of $1 million, they take that insurance cost and they spread it over 10 years, right? So the challenge is, in a 10 pay, it can be really efficient over a 10-year period, but on the first year, the liquidity is always gonna be a little bit less. But once again, you don't solve long-term problems with short-term thinking. And so for a lot of people to be able to say, hey, I'm gonna fund this over a 10-year period and it's gonna be better than a bank. And yes, I'm gonna have to give up some liquidity in year 1 and 2 and 3, but it's gonna really make up for it after the fact. That can be really worth it. 15 pay is the same concept, but it just spread over 15 years. 20 pay, same deal, over 20 years. But the bottom line, the challenge that I have with these is, I think what happens is, a lot of times, these 10 pays, the challenge is they're sold. If you're doing a big 10 pay, I can get behind it. I'll say it that way. If you're doing a big 10 pay and you have a lot of cash flow, I get it, I can get behind it, and I can back it up, and I can say, all right, I can see why you might want to do that because it's covering all your needs. The challenge is, a lot of people are trying to do small 10 pays and they're doing it with a short-term mindset. They're doing it because they're doing this because they don't understand what they're really getting involved with, and they haven't really figured out why they're buying this policy, what role they want this policy to play in their life. And so what happens is, if you do a 10 pay, you cannot pay anything after, right? So you can, after 10 years, you cannot pay any premium. You are stuck paying that 10 pay and you are done. So after 10 years, you can never put more money into the policy. And the challenge that I have with that is this, is that these policies, when you understand that most of the fees and the expenses and everything are in a whole life policy in the first 2, 3, 4, 5 years, right? After 5 years, there's not another place in the world that if you were to just look at the performance of the policy, dollars in, dollars out, growth, efficiency, tax benefits, everything that goes along with it, year 6 and beyond in a policy, it would be the best asset in the world, and there's not even a close comparison to it. The challenge is people have a hard time looking past year 1, 2, and 3, and maybe 4 and 5, depending on how the design of the policy is and how old you are and maybe how you're funding it. But they have a hard time looking past those first couple of years when there's an inefficiency, where you're upside down, where you maybe lost a little liquidity of your money because of the fact that there's other costs and other benefits that go along with it. And so they have a hard time looking past that. And so they go, well, if I could just pay on this as short as possible, that would be great. So they see a 10 pay and they're like, whoa, I can pay this up. And then after 10 years, I don't have to make a payment. Don't get me wrong. If you're 55 and you're going to retire at 65, and then a 10 pay can be great. But if you're 35 and you know that you're going to be working until 60, why would you want to do a 10 pay? Because I promise you, when you hit your 7 and 8 and 9 and 10, once you understand what you're doing and the type of asset that you have, and every dollar that you go in is growing, it's the most efficient way, place that you could put your money at that point in time. But if you have a 10 pay, you shut your ability off to be able to keep funding this policy. You've got to start over. Now, could you get another policy at that point in time? Yes, absolutely you could. So what would I do? I would say the only way, if I'm young, that I would suggest getting a 10 pay is by doing a 10 pay, being completely efficient with it, right? I would do that 10 pay, and then I would add a convertible term policy. And the reason I would add a convertible term policy is because what happens if during this 10 pay period you become uninsurable? You get sick, you get cancer, you get into a car accident, you get disabled, you get something like that that makes you completely uninsurable. Once again, I say this a lot. We get phone calls every single week with people saying they wish they had access. They wish they had access to more insurance, and they bought a term policy that was not convertible. It's about to expire, and now they're no longer insurable, and this happens all the time. Well, make no mistake about it, if you buy a 10 pay, you fall into that category. You can't get more insurance, and so I'd always go for a convertible term policy, and I'd always, because of the cost, especially if you're young, I'd always go with an extra $1 million if you qualify, at least of convertible term, because you can get at 35 years old, I'm telling you right now, you can get it for like 45 to $60 per month, right? So why would you not do that? If you can put that in place, get the coverage, you lock in the convertibility. That convertibility, when you convert it, you're going to get the living benefits and everything that goes with it. And when you hit the end of the 10 years, if you decide that you want to do more, you can convert it and kind of repeat that process. So it's a really, really powerful tool that you can leverage in that place. So on any of these limited pays, I would say, I would look at making sure that you add this convertible term policy. So as I look at this, what do we have here? We've got the L95, the limited pay through 65, the 10, 20, 15 pay. I've covered the fact that you can RPU, these more full pay policies. You can use the premium offset feature. Listen, the bottom line is you can use the RPU in any policy, even the 65 and 75 pay. You can RPU a policy any time after year 7. And that's a big thing. So once again, this comes down to control, right? And so no matter what, like, why buy a limited pay product here if you're not sure? If cash flow gets tough, I'd pay for 10 years or maybe go to 12 years, and then I would RPU it after that. Now you could, there are some downsides if the living benefits are really important to you, if that's a big portion, which I would encourage everybody to put more weight on the living benefits than they typically do, because the value of them is extremely, extremely valuable, right? Like there's a much greater chance that you're going to use your living benefits in retirement than you expect, I believe. So don't underestimate the power of that. But here's the deal. Let's get into this other thing when we talk about, which is, I talk about this all the time, indexed universal life. Now, when a lot of people say, Chris, you've done videos on why you can't use index universal life for infinite banking. You talk about how you don't like index universal life because there's a lack of control. Let me talk about why. I'm gonna scroll back up here to kind of illustrate a concept. Full pay whole life is meaning you're always gonna have a cost of insurance every single year. Now, the good part about the full pay whole life is that the cost of insurance is level COI, okay? So that's good. The negative is that you're gonna have this cost of insurance in retirement if you were, for 55 years, if you live to 120. But the good news, that's the bad part, is it's 55 years. The bad part is that, the good part is that it's level, it's controlled, and so the policy is safe. The same with the 95, 30 years, you're gonna have the premium and you're gonna have to deal with it. The other good part with whole life is that you have the control that anytime you wanted, if you needed to, you could reduce pay up it, meaning you're going to eliminate all the costs and the expenses, and you could premium offset it, which is a much safer way to control everything. With an index universal life policy, the problem is there's no control. You have annual renewable term. I'm going to just do ART, annual renewable term, meaning when you are young equals cheap insurance. So a lot of people will say that index universal life is cheaper than whole life insurance because they say, hey, when you're young, the cost of insurance is based on annual renewable term. So if you're 35, you're paying a 1-year term policy for a 35-year-old, and it's cheap. Don't get me wrong, and I'm not gonna try to BS you. Absolutely, on a year-by-year basis, it is cheaper with IUL than it is with whole life. But once again, you can't solve long-term problems with short-term thinking, and that is the most scarcity short-term thinking mindset, thinking about buying cheap insurance with annual renewable term inside of IUL for a couple of years. Because then what happens is when you get to retirement, you're still paying annual renewable term. Now, they always say that you're gonna have an increasing death benefit while you're alive or when you're funding the policy, and then you're gonna get to retirement and you're gonna switch it to a level death benefit, so the net amount at risk and the insurance amount is gonna be shrinking, and therefore the cost of insurance will go down. But the problem is it's not that clean, because then in retirement you take income, because that's the only way people buy IULs, is buying them for the income. And when you take income and then there's negative years, the net amount at risk in the company increases, and so then as you get older, the net amount at risk can increase, and because it's annual renewable term, when you get from 70, let's say, to 71, the jump in the cost of insurance year after year goes up along with it, and you don't have control. The bottom line is you can never pay up an IUL. You can never pay up an IUL. So there's gonna be constant increasing annual renewable term. And I've literally shown this, so people, by the time they hit 85 years old, the cost of insurance, you're talking like 35K plus on these policies. Obviously, it depends on the amount of insurance that you have, but we're talking 35K plus on only like 250K of net amount at risk, right? Net amount at risk. So it's like, it's a huge fee when it comes to managing this. And so when people say IUL is cheaper than whole life, it's cheaper for the first 15, 20 years, but when we talk about the lifetime of the policy, which is ultimately what matters, because we're not buying an IUL for short-term benefit, because there's short-term surrender charges that are worse in IUL than they are with whole life. We're talking about, we want this thing for our life, so we got to look at what the fees are for the life of it. And that's why when I look at cash value life insurance, I'm always looking at not doing index universal life. And if you follow this channel, you understand that, you understand why. I'm always looking at one of the versions of these whole life policies. I am a huge fan of utilizing one of these two, the pay through 65 or pay through 75 policies, these kind of pseudo limited pay policies, building in flexibilities, and then we can get creative with different premium offsets that end earlier, so that like at 65 years old, not 95 years old. So that puts less stress on the policy for a shorter period of time. That gives you more control, more power, more flexibility in retirement to utilize your policy as a volatility buffer and for other things. And so, I don't know. For me, those are the things that I look at. Those are the variables that I kind of contemplate when looking at different types of cash value life insurance. I know it's confusing because a lot of people are like, oh, just get a whole life policy or just get an IUL. Well, never get an IUL. But if you're talking about just getting a whole life policy, not all policies are created equally. It's not as simple as just go get a policy with Mass Mutual or Guardian or Penn or One America or Lafayette or any of these companies. They all have different products. Every company has different products that can be good or bad fits. The key is you understanding what your goals and objectives are, how they fit you, and don't get like so sucked into the, I need to just get a policy with this company because they're the biggest company or they're one of the big four. The bottom line is every single one of these mutual life insurance companies has the same kind of rules and guidelines that they have to use with their general fund for investing. And so I actually personally like some of the smaller companies the most. My next policy that I'm doing right now is going to be with one of the smaller companies because I personally believe in this environment right now. Those smaller companies are more nimble, and it's kind of like the Titanic. Some of these bigger companies' general funds are so big that, you know, they're market movers if they got to make major shifts. And I believe right now in the world that we're in, there could be reason for these companies to need to make major drastic shifts in their general funds. And some of these companies are going to have a hard time doing it because their general funds are so big. I'd rather be with a smaller mutual company that's a bit more nimble. And that's one of the reasons that I've been so strong on some of the recommendations that have been given to people that we've been talking to lately. That's it. So anyway, hopefully you found value in this. Hopefully this gives you clarity and gives maybe a little more insight as to maybe what's best for you, or if you're selling to clients, give you a little more insight as to how you can help people. If you're somebody who's looking, if you're an agent that's looking to get into this and you're maybe interested in selling whole life insurance because you've been looking at IUL and you're starting to get the sense that maybe IUL isn't what you thought it was, and you're starting to wake up to that, and you want to learn more about this whole life thing and you want to figure out how to sell it. We did launch an IMO last year, and I don't talk a lot about this, but if you are interested, down in the link below, we have a link in the description. You can go down, set up an agent interview. We are actively growing our team, and I think we have some of the best training. If you like our YouTube videos and you are an agent and you want to join and you want the support and you want the training and you want to be with an organization that is not about recruiting, that's not about you going out and selling to all your family before you know what the heck you're talking about, that is what we're doing. That is why I created the Life 180 Insurance Agency, to be able to help people focus on becoming the best agent you can be before going out and selling people stuff that you don't understand fully. As you could probably tell by this channel and the content that I create, I'm hardcore understanding what you're doing before you go out and hurt somebody with bad advice. So that is it. Hopefully you found value in this. If you did, please like it, share it. If you haven't already, make sure you subscribe and hit the bell that way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.